Diving into investing aggressive versus defensive. Investing sparks dreams of wealth and financial freedom, but it's not one size fits all. Different approaches suit different goals and risk appetites. Two primary styles dominate: aggressive and defensive investing. What sets them apart? Let's explore. Aggressive investors ride market waves for big returns. Defensive investors navigate calmer waters to protect their investments. Understanding these styles is crucial for making your money work for you. The aggressive investor, riding the waves of risk. Aggressive investors are the thrill seekers of the financial world. They embrace risk, viewing market volatility as an opportunity rather than a threat. These investors are not fazed by the ups and downs of the market. Instead, they see potential for significant gains in those fluctuations. Their primary objective is capital appreciation, growing their wealth as quickly as possible. To achieve this, they often allocate a significant portion of their portfolio to stocks, particularly high-growth stocks, with the potential to skyrocket in value. Options trading, with its inherent leverage and higher risk, is another tool often employed by aggressive investors seeking to amplify their returns. They're in it for the long haul, understanding that time is their ally when it comes to weathering market storms and realizing substantial gains. The defensive investor, seeking stability and steady growth. Defensive investors prioritize safety and capital preservation. They seek investments that offer steady returns and are less susceptible to market swings. Volatility is their adversary, and they aim to minimize its impact on their portfolio. Their focus is on preserving wealth and generating a consistent income stream. This makes defensive investing particularly suitable for individuals nearing retirement or those heavily reliant on their investments for income. Government bonds, known for their low default risk, and dividend-paying stocks of well-established companies, are staples in a defensive investor's portfolio. While the potential for explosive growth might be lower, so is the risk of substantial losses. It's a trade-off that resonates with those who value peace of mind and sleep soundly, even when the markets are turbulent. Section 4. Defensive havens, sectors built for stability. Certain sectors are considered inherently defensive due to the essential nature of the goods and services they provide. These sectors tend to perform relatively well even during economic downturns, making them attractive options for defensive investors. Utilities, for example, are responsible for providing essential services like electricity and water. Demand for these services remains relatively stable, regardless of the economic climate. Consumer staples, encompassing everyday necessities like food and beverages, also experience consistent demand. Healthcare is another defensive sector, as people require medical care in both good times and bad. Companies operating in these sectors often provide a steady stream of dividends, further bolstering their appeal to defensive investors. Section 5. Charting your investment course, a personalized approach. The choice between aggressive and defensive investing is about aligning with your circumstances, risk tolerance, and financial goals. Aggressive investing suits those with a long time horizon and tolerance for market volatility. Defensive investing is for those prioritizing capital preservation and a smoother market ride. Assess your financial goals, risk appetite, and investment timeline. Seek guidance from a qualified financial advisor for personalized advice. Remember, investing is a marathon, not a sprint. Choose the path that lets you navigate markets confidently and achieve long-term goals. Disclaimer. This information is for educational purposes only and should not be construed as personalized financial advice. Consult with a qualified financial advisor before making any investment decisions.